Imagine if you could earn money from hundreds of small companies without having to be a founder yourself. BDCs make it possible. By definition, these are publicly traded private equity or private debt companies. BDCs were introduced in the USA in 1980 to make capital more accessible to small and medium-sized businesses. And the legal highlight is that there is a 90% profit distribution requirement here. That's also how the high dividend yields come about. And that's exactly what leads to returns of 8 up to 12%. Let's take a look at 3 concrete examples. Stock number 1, Main Street Capital. My entry point here was 48 euros and 64 cents. Currently, we have a price gain of 16% here. Received dividend of 2 euros and 49 cents. In total, I currently hold 4 shares. Main Street Capital currently pays out monthly, has never cut its dividend, and even kept it stable during crises. The focus here is on lower middle market companies and equity investments. At the moment, we see a dividend yield of just under 7%, dividend growth over 10 years of 7%, over 5 years 7.98%, and over 3 years even 20%. Here we can already see that the dividends for all the coming months have already been announced. Now let's take a look at Main Street Capital with InvestingPro. You can find the affiliate link below in my description. The 52-week low, or rather, the low is between 40 and 58 euros. Currently, we are at 56 euros and 49 cents. Analysts have set a target here of 51 euros and 92 cents. Current dividend yield of 5.99%. The company is definitely in a very good financial position. If you think of BDCs as a relay, Main Street Capital would be the reliable locomotive at the front. Stock number 2, Ares Capital, the largest BDC in the world with a 20 billion portfolio. We have a very broad loan book, healthcare, software, industry and services. My initial investment was 18 euros and 84 cents. In total, I hold 11 shares. The current exchange rate is 19 euros and 20 cents. This results in an increase of 3 euros and 94 cents. And I have already received a dividend here from 5 euros and 24 cents. The current dividend yield is approximately 9%. Here too, we have seen steady dividend growth. Over 10 years, it's at 4%. Over 5 years at 3%. And over 3 years at 8.56%. And that's exactly what we want to see, that the dividend continues to grow steadily. Here we have a larger balance sheet, better refinancing options and institutional investors on board. That means there is less volatility, it's more defensively positioned, the Berkshire Hathaway among the BDCs. The 52-week high and low range from 16 to 20 euros, currently standing at 19 euros and 15 cents. Analysts have set a target here of 19 euros and 89 cents. According to investing.pro, the current dividend is 8.57% with a payout ratio of 90%. The company is currently in a good financial position. Ares Capital even has an investment grade rating. That is a rarity among BDCs. Stock number 3, Oxford Lane Capital. We have an extremely high cash flow with a yield of over 12% possible. The business model specializes in CLOs. CLOs are bundled corporate loans. The advantage, huge cash flows. The disadvantage, it is very risky, highly dependent on credit quality and interest rates. So significantly riskier than Main Street Capital. But for high yield hunters, it can be extremely exciting. Oxford Lane is like a high-performance sports car. Fast and exciting, but not made for every road. My entry price was 4 euros and 7 cents. Currently, we're at 2 euros and 93 cents. I hold a total of 32 shares. That corresponds to an unrealized loss of 36 euros and 47 cents. I have already received a dividend of 5 euros and 27 cents. Currently, we see that over 3 years, the dividend has been increased to 11%. Over 5 or 10 years, it was reduced, overall once by 8% and once by 6% over a 10-year period. Here too, the next dividends are already secured. And these have already been officially announced, including the amount. So now let's take a look at the data. the 52-week high, or rather, the low is at 3 euros and the high at 5 euros. Currently, the value is 2 euros and 92 cents. Someone here is listing a price target of 3 euros and 85 cents. The company is not in as good a financial position as the previous BDCs. And those are the criteria. Currently, we have a dividend of 31.58% with a payout ratio of 636%. Many people wonder why the payout ratio is so high. It seems that way here, as if the dividend isn't covered at all. The reason for this is that CLOs generate enormous cash flow even if the balance sheet shows losses. Specifically, this means the dividend comes from cash flows, not from traditional balance sheet profits. That's why the payout ratio according to GAAP accounting looks so insanely high. That's Oxford Lane's unique selling point. Brutally high returns, sometimes over 12%, but with more risk. So what does this mean for us as investors? Main Street Capital, conservative cash flow, even monthly. Perfect if you want stability. Ares Capital, the giant. Defensive, diversified, almost a core investment in the BDC sector. Oxford Lane, the high yield bet. Risky but with double-digit returns. BDCs are dividend machines, but they are heavily US focused, highly dependent on interest rates and on the quality of the loans they issue. In the next part, we'll take a look at New Tech One and Hercules Capital, two BDCs that operate quite differently. As always, this video is not investment advice, but simply my personal strategy. Until then, successful investing.